I think the big picture is disinflationary, maybe bordering on deflation, which is a central banker's worst nightmare. Because they say, we don't worry about inflation because we'll just raise rates until it goes away. It's debatable, but that's what they think. But deflation, they don't have a formula. I mean, QE doesn't work. QE is a joke. And by the way, when I say that, I should be clear, there's a lot of empirical evidence that's come along since 2008, globally, looking at other countries that have done this, that says QE doesn't work. And so you can do it, it's for show, you can talk about it, but it doesn't cause inflation. I mean, just take the end of the last recession in 2009, or not counting 2020, I don't know what that was. I mean, the economy dropped 30% in 2 months. But treating that as COVID-related, turning out the lights, not really fitting in any economic model, but going back to 2009, March or June 2009, the end of the last recession, to the end of 2019, just pre-COVID, and COVID got crazy. 10 years, 10 years. The Fed balance sheet went from $800 billion to $5 trillion. That's base money, M0 money supply. $800 billion to $5 trillion. There was no inflation. There was no inflation. They couldn't get inflation. The annual growth, average annual growth for the whole 10 years was 2.2%. Our potential is 3.5 if we do everything right, have good policy and so forth. When you're growing at 2.2 and your potential is, I'll say 3.25, that's what Keynes called a depression. And I've said, I don't have to play the recession game, I mean, I know what they are, but I said in 2007, we entered a depression. And we've been in it for the 14 years, or 17 years since. And guess what? Japan went into a depression in 1990. They've had, you said they came out the other day, the data shows they're in a recession. That's right. This is their 9th recession. It is. This is their 9th recession since 1990. What do you call 9 recessions in 30 years? I call it a depression.
Yeah, and there's a great example of unlimited QE.
Right. QQE.
Yeah.
So let's buy the stock market while we're at it.
Yeah.
But yeah, which has no impact at all. What does have impact is psychology expressed as velocity. In other words, you can have hyperinflation on a pretty small money supply if the turnover goes to 3, 4, or 10 or some big number. But that's psychological. People have to, and that does feed on itself. That's not supply side inflation, that's demand side inflation. But the problem with that, supply side inflation tends to self-extinguish. When prices get high enough, they come back down depending on what they are, because people will produce more, solve the inefficiencies in the supply chain. But the demand side inflation has no natural cure. It does feed on itself and grows exponentially. So that kind of psychological change, which I don't see right now, and velocity, which feeds on itself, will give you as much inflation as you want, regardless of money supply. So that's why I say that's kind of irrelevant. But you have to factor in geopolitics. I mean, there's no, so we're building a neural network right now because we're getting all our nodes and factors. But the geopolitics are obvious. I got into a debate the other night with a guy who's like, we could bomb the Houthis back into the Stone Age. I said, well, I got news for you. First of all, they're in the Stone Age. So today, that's part of your problem. They're living in caves, so they're actually in the Stone Age right now. And I said, we can't. They've been getting bombed for 30 years by the Saudis, the British, us. It hasn't stopped the Houthis, but the Houthis have shut down the Suez Canal. I mean, when you close the mouth of the Red Sea, other than Jeddah, I don't know, what you're doing is closing the Suez Canal. So they have closed the Suez Canal. The ships are going around Cape of Good Hope, pretty place, but it's a long way from the Suez Canal. The oil will get through, but it'll be delayed and it'll be more expensive because the transportation costs are huge. The price of the bunkers are going up, and that feeds on itself. So you're disrupting the supply chain again. So that's an inflationary impulse. You can get into a debate with smart people. That's not really inflation, it's supply chain. To me, if the price goes up, it's inflation. But I grant that there are two different kinds, supply-driven and demand-driven. And your greatest danger is that when the supply-driven inflation, and geopolitics is part of it, leaches over into the demand side and expectations change, and then it feeds on itself and gets out of control. So the short answer to the question is, I don't see a significant decline in the rate of inflation. In fact, I can see the rate of inflation going up, at least for several months, or perhaps longer, based on the geopolitics, which means there's no pivot.
Yeah.
The most dangerous situation of all, which is, because you said, yeah, well, the Fed, forget inflation, put it to one side, the Fed will cut rates if unemployment starts to go up, job creation, goes negative, we're losing jobs, et cetera. And then that's a whole other arcane debate about full-time versus part-time and real wages going down. And I always look at the degree distribution. It's like, okay, you tell me an average wage, fine, but I got to average like you and Jeff Bezos, and then, or me or anybody. And that degree distribution is extreme. So you can't even rely too much on the averages, because 90% of the people could be taking a real wage cut in a world where real wages are going up a little bit, because a small sliver who don't need the money are going up exponentially. Leaving that to one side, you said if unemployment gets worse, job creation goes down, et cetera, that's first of all, a sure sign of recession. It's almost the definition. It's a lagging indicator, which means we're really into it at that point. And the Fed would cut. I agree with all of that, but you could still have inflation, and the name for that, as you know, is stagflation.
Yep.
That's the worst of all possible worlds. And go back to 1979, 1980. What was the state of the world? 10% unemployment and 13% inflation. We're like, there is no Phillips curve. It's like the terminal rate. I understand Phillips was a prominent economist, and I understand that you can compute it, but the last time I looked, Phillips curve was flat, not much of a curve. But the point being, the Phillips curve is junk. It's junk science, because you can do a quad chart, and hedge likes quad charts, so do I, so does the Pentagon. You can do a quad chart and say high inflation, high unemployment, because you're in a inflationary, or you can have high inflation, low unemployment, or you can have low unemployment, low inflation. You can fill in all four quads, and which means that there's no causality. There is no correlation. So in I said 1979, 1980, we had high inflation, high unemployment. According to the Phillips curve, that doesn't happen. From 2009 to 2019, we had unemployment came down and then stayed low, and inflation was low. Phillips curve said that shouldn't happen, but they both did. It's in the data, and you can find the other two.
These things are like,
you can fill in the other two quadrants.
They're
also. Same problem. That was my most difficult course. I had a lot of A's, and I just struggled a little bit in economics, and it took me like 30 years to realize that what they were teaching me was garbage. So the reason I couldn't understand it was because the same experience. But there was almost a sense, and I can't prove this, that they had to teach you a bunch of garbage so that you could find your way to real economics. But most people never found their way. They kept doing this stuff.
Yeah.
Now they're running the Fed.
That's crazy.
It is crazy, but with all due respect, I consider PhD in economics to be kind of a handicap. You ought to get your own parking space for that, because what the Phillips curve is junk. The terminal rate is an invention that has no support in a complex dynamic system. There is no such thing. Fed funds target rate, there is no Fed funds market. The Fed funds market was invented decades ago or longer so that banks that needed to meet overnight reserve requirements could get money from other banks.
Yep.
That was what Fed funds were. But we have, I think, $6 trillion of excess reserves. There hasn't been a Fed funds market for a long time, because we have trillions in excess reserves, but they're targeting the Fed funds target rate. But what they're really doing, of course, is targeting the repo rate. But they don't even admit that, because they call it SOFR, System Overnight Finance, I forget what the rest of the acronym repurchase agreements, but which they had to bank to get rid of LIBOR. I mean, they just keep making it up.